Sustainability and ESG are now more important than ever. Shareholders are demanding that companies start measuring the extent to which they manage their environmental footprint, to the extent they enhance diversity, and to the extent they are transparent in their contributions to a country.
Welcome to Buzz House, a Baker Tilly podcast where you can find all the buzz around multifamily housing. I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrett Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Each week, we'll bring you a guest or a topic in the multifamily housing industry that will help you win now and anticipate tomorrow. Let's get started. Our guest on the Buzz House is Christian Albuquerque, who is the Managing Director of Fallbrook Capital Markets. We're going to have a discussion with Christian about environmental, social, and governance, otherwise known as ESG, as an investment strategy. Before jumping into our discussion with Christian, we have a couple of items of industry news. In much anticipated news, the Senate Finance Committee released its portion of the updated Build Back Better reconciliation bill. The housing credit provisions are largely similar to those passed by the House of Representatives in November, with one key change to the annual housing credit allocation increase, and also a technical change to the basis boost for extremely low-income households. Regarding the credit, the change in the Senate version is extending the allocation increase through 2025 rather than 2024, which requires a much lower allocation increase in the earlier years to eventually achieve the same allocation increase by 2025. We also believe this provides a much better position to extend the provision beyond 2025. Regarding the extremely low income boost, the clarification was that the boost only applies to the fraction of units that serve very extremely low income households. So again, the 50% basis boost only for ELI households. Additionally, also highly anticipated news was the release of IRS Revenue Procedure 2021-43, which addresses if and when a bond deal, which closed in 2020 before the tax credit percentage was fixed at 4% at the end of December, can get a 4% fixed rate. It was confirmed that projects with drawdown bonds, meaning deals that closed in 2020 and have a traditional monthly draw of the construction loan, are not eligible for the fixed 4% rate. What would be eligible would be projects with supplemental bond issuances equal to a total of 10% of the total bonds issued for the project. Garrick and I are working with a couple of HFAs right now on projects who fit these circumstances, so we'll be able to let you know what we learn through this process. Next, we have talked about income average or average income and how the industry has been in somewhat of a holding period since the IRS public hearing in March of 2021. Recently, NCSHA and 31 other stakeholders sent a letter to the IRS and Treasury urging them to expedite issuance of the final rule of the housing credit average income test. The proposed rules came out back in October of 2020, and as you're well aware, many investors are not putting dollars into these projects with average income. So we hope to see more out of the IRS, hopefully here in early 2022. And finally, also of interest is NCSHA and others in the industry sent a letter to Treasury Secretary Janet Yellen urging the U.S. Treasury Department to modify existing guidance on the coronavirus state and local fiscal recovery fund to provide more flexibility in the use of these funds in developments financed with local housing tax credits, being structured around, grants, can they be loans, things like that just from a purely structuring position make them much more compatible with LIHTC deals. More to come on that as well in the new year. Now, very excited that we're going to jump into our conversation with Christian. Garrick?
Yeah, thanks, Don. That was a great intro. Christian, we're obviously glad to have you here on our Buzz House today. Why don't you go ahead and just start out by letting our listeners know a little bit about Fallbrook Capital and your role within that organization?
Sure. Well, yeah, to start off, Fallbrook Financial Services is an investment banking firm that specializes in the tax credit industries, such as the low-income housing tax credits, historic tax credits, and investment tax credits. We've been around since the early 90s. My role within the company is as managing director of Fallbrook Capital Markets Division, and I oversee a few of our debt and equity strategies.
Awesome. Thanks for that intro, Christian. So let's go ahead and just kind of dive in to kind of figure out what's this environmental, social, and governance ESG program all about? So could you maybe start by explaining what ESG is and why it has risen to importance in your line of business?
Yeah, no, we're really excited about this initiative. So to begin with, obviously ESG stands for environmental, social, and corporate governance. And it considers the impact a company has on its employees, customers, and the communities where it operates. Sustainability and ESG are now more important than ever. Shareholders are demanding that companies start measuring the extent to which they manage their environmental footprint, to the extent they enhance diversity, and to the extent they are transparent in their contributions to a country. All these factors have an impact on the company's license to operate, which really, in the minds of the stakeholders like regulators, the governments, and increasingly NGOs powered by social media, is very important. The reason it's relevant is that an increasing body of research shows a positive link between ESG performance and financial performance, or really, in other words, value creation.
Christian, thanks for that overview to kind of start off the discussion. Christian, how will ESG investing impact companies, and what can companies do to improve their performance on these ESG metrics?
Right, yeah. So ESG metrics have become more important for public companies since an increasing number of shareholders, including the world's largest pension funds and mutual funds, are requiring ESG reporting of their stocks and their portfolios. So in the long run, companies will be penalized by lack of investor interest if they are not delivering on ESG. The type of ESG investing really depends a lot on the industry in which you are active in. So it varies. Oil and gas industry focuses on carbon emissions reduction. Pharmaceuticals industry focuses on drug safety and quality. So really taking an industry by industry lens is critical. That said, we work with all types of companies and connect them with sustainable investments across affordable housing, the preservation of historic buildings, the creation of renewable energy, and even sequestration of carbon itself. Now, we are still very early stages of ESG reporting. And really, one of the challenges for major investors is a lack of strong metrics for ESG. But we think once ESG reporting becomes more standard and can be more easily compared, it will make it much easier for executives or investors to correctly value investment decisions.
You just mentioned, obviously affordable housing, and that's very important to us here at Buzz House. So, we obviously work heavily in affordable housing, and I know Fallbrook has a large presence in the tax credit industry as well. So do you see ESG playing a large role there?
Yes, definitely. For example, we see a tremendous role being played in the affordable housing LIHTC program, where ESG is starting to compete with CRA motivated tax credit buyers, and also competing directly with regulatory agencies such as HUD, Fannie, and Freddie. We've developed strategies for companies to invest in tax equity and also in fixed income products through our platforms. The LIHTC program offers ESG investors the opportunity to earn sustainable yields through these strategies, which in turn provides developers more access to low-cost capital, all while helping to respond really directly to the affordable housing crisis in this country. Our ESG-driven investments can deliver financial returns in the short and long term, while really generating positive value for society.
Christian, actually, just one question related to this last answer. Are these investors, new to the market? Has it been existing investors maybe re-looking at what motivates them and so forth? Do you have a thought or two on that?
Yeah, and so this concept has been going on for the last 10 years. Truly, in the last 5 years, it's become more meaningful based off all of the items related to the environment and the pandemic. And so right now, investors, specifically young investors, and what we're seeing in terms of the future is that they're going to be very conscious about what companies are doing for society and how they're impacting the world. And so really, we're starting to see a lot of momentum coming in, and it's already $1 trillion market. We already see it going into the trillions, really because companies will be penalized in the future as the new generation of investors are looking to invest in companies that they feel aligned with, in the future.
Very good. No, thanks for that. I know it's it's like you said a little bit earlier, how you measure this, and it's a little bit nebulous for just people hearing about it. They know there's a lot of excitement, so that was helpful to get that vision. One last question, Christian, can you give us examples maybe of how, we represent a lot of borrowers, developers. How are borrowers benefiting from your ESG strategies?
Sure thing. Yeah. And, we've been working with our ESG investors to create strategies in our marketplaces where we specialize in, obviously, the tax credit space, and the low income housing tax credit program being one of them. But a great example is our ability to provide private placement debt financing executions that directly compete with HUD, Fannie, and Freddie. So traditionally, those three agencies have provided most of the liquidity in the marketplace. But in the last couple of years, due to the demand in new housing, the timing associated with closing of those transactions have been in excess of 6 months for Fannie and Freddie. And in the case of HUD, it can take as long as 12 months or more. Our cost of capital falls between HUD rates and Fannie Freddie rates. And when you combine that with our speed of execution, which is generally around 30 to 60 days to close, borrowers can now close on their transactions with more certainty and really help improve their efficiency to take on more deals. Since there is a crisis in affordable housing, we really want to speed up the production of the inventory for that industry.
And Christian, just one follow-up question to that. So you see, you're coming into 2022 that kind of this private placement is going to be a big business from you, a big volume, and you've got a good number of investors that are motivated by ESG and so forth.
Yeah, exactly. And really what I would say is, we're a conduit to investors and borrowers. Right now, I think being able to work with the understanding that ESG is at the forefront of the corporation's minds and they are budgeting for this. Really, there's kind of a misnomer that ESG is really only related to the environment, but there's truly an importance for social impact. So really rewriting the narrative of ESG under the basis that you want to focus in on the items that the country needs a lot of help on, and at the same time be able to qualify your ESG and get your scoring, and at the same time earn sustainable finance, has really driven a lot of the momentum. And so we're seeing tons of corporations coming to us to try to make sure that they're at least earning some kind of yield, and it's not necessarily a philanthropic play. They can budget it into their annual budget, earn some sustainable yield, and make a difference. So we're starting to see this becoming, like I mentioned, a multi-trillion-dollar marketplace. We just are trying to become that national conduit for the companies. Again, in return, all this is just going to drive a lot more education into the marketplace. More educated capital brings the cost of capital down, and we think that it's going to help everyone in the long term.
Very good. Really, really appreciate your time today, Christian. And
yeah, we really appreciate it.
Thank you, listeners, for the Buzz House for tuning in.
No, thank you for having me. It's been a pleasure. Really appreciate it.
Thank you for listening to Buzz House. To receive a notification when new episodes are available, please subscribe to Buzz House, a Baker Tilly podcast, wherever you get your podcasts. For additional resources around multifamily housing, check out bakertilly.com. And if you have a suggested topic, please send them to build@bakertilly.com. That's BUILD @bakertilly.com.